So we'll go through the presentation quickly. I think it'll give you at least a sense of the company beyond what you may or may not already know. And then hopefully you'll have some really stunning questions. Yes, here's the forward-looking statement. Now we're to the meaty part. Actually, this is probably the only slide that we should use. Why should somebody look at the company as a prospect for investment? To me, it's relatively simple. I'll come back to why I think that's the case in a moment. But we, several years ago, came to the conclusion that the world would likely change from the way it was valuing things, what was important from a customer perspective, et cetera, and concluded that our customers were very conservative and that they wanted a company that was profitable, strong balance sheet, where taking a technological leap wasn't something that put their company at risk. So we've now had 27 consecutive quarters, roughly, of GAAP profitability. We report GAAP, not non-GAAP. We've converted ourselves over the last several years to what we think is a pretty visible recurring revenue model. We have very low churn amongst our customers. We're very good at the management of cost. We are because we're good at investing, if you will, in our own technology to improve the productivity of our people. As an example, one metric is for a software company, revenue per employee. On a recurring revenue basis, we're just under $300,000 a year per employee, which is typically the sort of number you only get with much larger companies. So we're really good at managing a pretty much fixed cost structure. We have a very strong balance sheet. The amount of cash on the balance sheet in March was about $21 million. That creates tremendous peace of mind for our customers. As I said, they're very conservative. We're actually pretty well scaled. Our goal over the last several years was to think of the business as a network. That network has now 340,000 connections. We have tens of thousands of distinct customer names. We're recognized actually as, in our space, as being a well thought of name. We're actually quite well known, but we are in the largest industry in the world. Most people don't know that retail food in the United States is actually the largest industry on planet Earth. I'm not one of these people that thinks how big the addressable market could or should be. It's large enough to give us plenty of headroom. And then finally, very importantly for our customers, we are actually exclusively endorsed by the industry that we serve. In other words, retail food, think of that as supermarkets, et cetera, has several trade associations, all of whom actually endorse us exclusively. So we are considered, if you will, an industry insider and well thought of by our customers and, frankly, the industrial marketplace that we serve. Okay, let's go to the next slide. Again, this is that magical, how big is the market? It's big. It's big because the industry, as I mentioned, that we serve is the largest industry in the world. We do a variety of things for that industry. I'll come back to that in a moment. But the pressures on the retail food industry are extraordinary. Let me describe those. First of all, it is by business model, high asset turn, very low margin. In a good year, retail food companies make 2 to 3% pre-tax. Wholesalers in the industry make 0.5% in a good year. So the reality is that it's a very difficult industry if you're an insider to manage. Risk is not something that people think about. On the other hand, having said that, they're subject to very high degrees of regulation by the FDA, the USDA, et cetera. It's an increasingly competitive environment. You may have heard of a little company called Amazon that's attempting to disintermediate the grocery industry. And at the same time, they have finicky consumers. Here's an example of what finicky means in changing tastes. One of our customers, who's thought of as the best supermarket chain in the United States, about 12 years ago, if you had gone into one of their stores, you would have found 40 different SKUs, 40 different size, shapes, and flavors of mustard. Now, when I was a kid, it was small, medium, and large French's mustard, but it proliferated to the point that 12 years ago, they had 40 different SKUs. Today, they have over 200. So in other words, consumers want organic, GMO, non-GMO, made in Vermont in a bathtub over the weekend, whatever it might be. But the truth is, it's harder and harder for supermarkets to maintain the ability to keep on the shelf the various kinds of products consumers want. When you put all of that together, it's a tough business to run. Let's go to the next slide. So what do we do for them? Well, we think of ourselves as a supply chain company. And what we mean by supply chain is a little bit different than other people, but conceptually, we, of course, manage transaction flow between suppliers and the retailers. In other words, our job, as we see it, is to figure out how much product needs to be on the shelf, store by store, SKU by SKU, forecasting, ordering, et cetera. So that's the transactional part of the industry. As a supply chain company, we certainly do that. But if you were to ask yourself the question, how much product should you buy from a supplier if that product is going to kill your customers? The answer is actually pretty close to zero, I would think. So in other words, somewhere in your supply chain calculations, we argue, you have to think about the safety of the people from whom you are buying. So we do compliance work, and we innovated that whole area about 7 or 8 years ago. And now the next idea really is, well, if you're going to vet suppliers, don't you first sort of like the recipe for rabbit stew is first catch a rabbit? Hell yes. So the first thing you have to do is you have to catch a rabbit. You have to find a vendor that conceptually you would work with. So we've established a marketplace, if you will, where buyers and sellers can find one another. And it enables the supermarket to buy those strange things like cheese made in the bathtub in Vermont that other supermarkets might not have, and enable you to differentiate yourself. So in other words, to us, supply chain really means help people optimize the flow, that's the math, help people make sure they're buying from safe vendors, that's critical from a liability perspective, and help them find those vendors in the first place. And we work across that entire platform end to end, and I'll come back to why it's sort of magical in a moment. Let's go to the next slide. This is a really tiny sliver of our customer set. We are humbled because we do business with so many big names and marquee names. We're very, very lucky, and we feel humbled by virtue of the fact that people have selected us to work with them, and we've done it successfully. Let's go to the next slide. So here's what's important, I think. We have one fully integrated platform that we support, one platform. We have many applications, but all of them exist in the context technically of a single fully integrated platform. When you look at other companies in the software space that typically have been built through acquisition, M&A of some sort, the CEO would most likely cut off one of its arms in order to have what we have, which is don't maintain 10 pieces of source code, don't have 10 development teams, have one. And that's what we do. So in other words, the sourcing, the vetting, and the transacting of our business all occurs in a single fully integrated platform. It is our strongest competitive advantage. Let's go to the next slide. So why is compliance important? Well, it's important because, one, you've read about recalls. Two, you've read about people getting sick from foodborne illness. There's the stats, 128,000 hospital visits, several thousand deaths in a typical year. And your government wants it to be safer. So there was a massive overhaul of food safety practices and regulations in 2011 called Food Safety Modernization Act, FSMA. And that act really changed almost everything. It created criminal penalties for violations. So the fact is the FDA now has been in a position for about 10 years to massively improve the regulatory climate around what goes in your stomach. And so far, not much result, to tell you the truth. But more is coming. We'll come back to that in a minute. But that's why compliance is important. It's a huge financial risk. Supply chain, why is that important? Well, supply chain is important because the number one complaint of customers who go to retail stores is out of stocks, not having the products they want on the shelf when they want them. Here's an interesting statistic. 55% of the time, if a consumer goes into a retail store to buy a product, if it isn't there, they go to a competitor. So the loss of a sale isn't the loss of a sale. It's the increased risk of the loss of a customer, the whole market basket, the whole shopping experience. What else? How about this? 24% of Amazon's North American business, 24% of their entire North American business, came as a result of people starting to shop on Amazon because they couldn't find a product that they needed or wanted in a physical retail store. So the consequence of poor supply chain management amongst retailers is that they don't just lose their customers to another physical retailer, but they send them to the dreaded Amazon. So that's where we work. That's our sweet spot in supply chain. It's helping retailers and suppliers stay on the shelf when customers want the product. Let's go to the next slide. And this is coming. I'm going to come back to this. I'm just going to touch because this is going to be a significant piece of our business. When I talked about compliance, I said up to this point in time, there really hasn't been a significant reduction in recalls and that sort of stuff over the last several years. It hangs in at around 1,000 recalls a year. Well, the intention of the act was the Food Safety Modernization Act, was really to find a way to take the highest risk foods initially and eventually all foods and have them traced from dirt to fork, farm to fork. And that hasn't happened. Strangely enough, although some of the compliance ideas were put into place, the idea of traceability was not. But now there's been some lawsuits. I'll come back to that in a minute. And the FDA is just about to announce its full regulatory menu around how to do traceability. And I'll come back to why that's important to us momentarily. Let's go to the next slide. Marketplace is where buyers and sellers can find each other. We believe that one day this will be a very important part of what we're doing. When we started this activity amongst our customers really leaned toward the idea of let us be in the middle, meaning repository in the middle of the transaction. So it became transactional, which made our revenue lumpy. And what we've done over the last year is to really take marketplace and sort of push it off to the side because of its lumpiness. And you will likely see this come back full-fledged because of the need that our customers have for finding each other. And it'll be more in a subscription format, but that's a future idea. Let's go to the next slide. So here it is. There's a way to think about it. We maintain tens of millions. It's about 60 million store SKU inventories. This is a way to think about our scale currently. We process, 100,000 invoices a day for our customers. We have a 90,000 plus supplier retailer compliance connections. It's actually now north of 100,000. We do millions of store SKU forecasts and orders every day, process 20 million transactions. We're actually a very highly scaled platform at this point. So in addition to the idea of scale of our network in the center, the 340,000 is the best metric of scale. Over the next several years, we want to see that number more or less double, but we also want to increase the scope of the network. Our idea has been sort of land and expand, get a customer, take great care of them. We really do that, by the way. And then if they have been successful with our technology and they feel like they're in a relationship with us, they're going to buy more. So we're very quickly approaching the point where they will begin to buy more solutions. So that same customer set will develop a much higher revenue profile per customer and to our benefit. Let's go to the next slide. There you are, scaling the network. What's it look like? Well, there's 40 or 50,000 suppliers that do business directly with retailers and wholesalers. And we have probably just under 30,000 of those today. But they in turn have suppliers. And those suppliers have suppliers, and so on and so forth. So the reality is there's about 1 million entities, we think. And isn't it weird that nobody really knows the number like your government? Yep. There's about 1 million entities down to the farm level that somehow or other produce ingredients, grow things, distribute things, etc., that end up in your stomach. We want them all. And that's the course that we're on. We think the existing customers we have can take us to almost all of that over the foreseeable future. Let's go to the next slide, Ian. So our business model really looks like this. It's now all recurring, 99.9% of it. We want to have about a 10 to 20% recurring growth rate of top line. We already have a very low customer churn. And from that, though, given how we manage our expenses, it's really a pretty much fixed cost business. It costs us about $1 million a month of cash to keep the doors open, which means everything really over that becomes not just bottom line, but free cash flow. So we're very focused on the key metrics internally for the business. How profitable are we? Most importantly, then, how's the cash? And what we're doing with that cash is pretty interesting. We have been shrinking our capitalization. So we see two drivers, if you will, to our earnings per share. We think ultimately the value of the business relates to the growth rate of our earnings per share. Organically, we want to grow earnings at about a 30% rate in nominal terms. But we think we go higher than that by continuing to shrink the capitalization. So going forward, there will be fewer shares outstanding. We've already bought back just under 2 million shares, and we would anticipate continuing to buy shares opportunistically over the next several years. So we would appeal to an investor who likes a conservatively run business, fortress-like balance sheet. I think our current ratio is 4.4 to 1 or some number like that. Very conservative balance sheet, great customer retention, and lots of opportunity for growth. Okay, so that's the summary. I think we can go, there's a couple other slides here. This is the next big thing. We've taken the last year of slowing things down and focusing because our government is about to announce the final regulations around traceability. It is revolutionary. Nobody is properly prepared for it because people didn't understand it. It was announced during the pandemic, bad timing, which meant the FDA wasn't very good at letting the world know what was going to happen. And more importantly, what they want is for this to spread to every product that people eat. Makes perfect sense from a safety perspective. It's just very difficult to accomplish. So the timeline looks like this. In the month of November, the FDA is under a court order. They were sued by the state of California. They were under a court order to publish and then enforce these regulations around traceability, and they will do it. It'll be done in the month of November. We've talked to them several times, no doubt, but that it'll happen. And we are quite confident that that's going to provide a very interesting accelerant to our business. We've spent the last year preparing for it so that we could execute as well as we typically execute. No disappointment is kind of the way we approach that. Let's go to the next slide. Our business model here is quite different than other people approaching traceability. You're going to see hundreds of people doing traceability, all of which involve putting a dopey label on a dopey box and hoping that the dopey guy in front of you can figure out how to scan that thing and get it into a system. That is an inherently a flawed idea. It is too expensive to scan every case. If you've ever been in a distribution center, you would just go, well, that's a non-starter. Whose dumb idea is that? It won't happen. Can't happen. Too economically impossible. So we've developed some ways without all of the need for scanning to capture the electronic information that the FDA is going to legally require. Our system requires no changing of people's existing systems. It's extraordinarily low cost. And most importantly, it works and will enable people to comply with these new regulatory changes. So we expect that we're going to be the player. In fact, we were recently not just endorsed, but partnered with the National Grocers Association, which is the largest trade association in the world in terms of independent supermarket chains. They are concerned about traceability. They've selected us to work with their members, and that represents something between 30 and 40% of the entire industry. Let's go to the next slide. So that's kind of what we've done is we've squeezed out all of our one-time revenue and replaced it with recurring revenue. And as we've continued to do stock buybacks and to reduce the burden that having too much cash on our balance sheet can create, we're very proud of this. The change in earnings year to year relates much more to the one-time revenues that we had, and those are now gone. So going forward, we think we're very easy to forecast, and we're hoping that our growth in earnings per share will become will warm the cockles of every investor's heart. So you can see that we bought back a significant amount of stock over the last several years. In spite of that, our cash balance is very strong. We have nearly 2 years of, if we had no revenue, we have 2 years of operating cash on the balance sheet. I think that's really it. I think nothing else here really matters very much. The rest you can look at if you're interested. Ian, how about if I try and answer some questions?
All right, give me a second.
Yeah.
There we go.
So, customer churn, what's the churn rate?
It varies a little bit year to year. Historically, it's been around 1%. Within that, about half of that is due to merger, acquisition, or going out of business. And the other half is typically related to a trading partner no longer doing business with the other side. So we actually lose very few people for what I call cause, and we're proud of that. We're proud of our customer relationships.
Okay, question from the audience. Please share with us relevant KPIs and trends, especially customer counts, average revenue per customer, applications per customer.
Yeah, I would, except that they make no sense. In other words, they're apples and oranges. And that's because we don't sell every application the same way. Let me give you an example. Our compliance is sold by virtue of a one-to-one relationship with a customer. So if I'm a supplier and I have 5 customers that are using our compliance management, he gets billed for 5 customers per month. In some of our supply chain applications, it's based on the number of stores that he's operating in. So someone could be operating with the same retailer for compliance, you'd get 1 bill, but he could be operating with that store with our supply chain activity. And if that customer had 1,000 stores, he would be paying us 1,000 times that month. So we can't really disaggregate how we spend or aggregate how a customer spends with us. What I can say is, though, in terms of cross-selling that we're really just beginning to do, I would guess fewer than 5% of our customers buy more than a single service from us. So over the next several years, the goal is not just to increase the scale of the network, traceability will do that for us, but substantially increase the revenue per customer by virtue of the fact they'll be buying multiple of our services.
Is electronic data interchange a part of your supply chain solution, or will it be?
The answer is we've been doing EDI since the very beginning. So we're pioneers in EDI. I hate to use a technical term, it's part of our stack. Many of our customers communicate with EDI. We do that for them. We include it in our service, and it's quite possible that we will pull that out at some point and actually make it a separate revenue producer. At this point, though, it's just given away to our customers to help them communicate with each other.
Does your 30% EPS growth aspiration rely on traceability taking off?
No. The traceability thing is hard to gauge both in terms of impact and timing. Let me explain that. Nobody knows, it's the government, but they will announce the regulations in November because they're under a consent decree, federal court consent decree to do it. So it'll happen in November. We're expecting lawsuits to try and stop it. We don't think the lawsuits have any chance whatsoever of stopping traceability. It's the law. It's not a case of just the regulation. It's the law. So it will happen. The question is, can the lawsuits postpone? And we hope it does. Right now, the proposed regulations, they were announced last year, give only 2 years for people to be fully compliant, fully rolled out. In our view, that's impossible. It cannot be done. We think it's a three minimum, 5 maximum, 3 to 5 years to actually roll this out across hundreds of thousands of stores. Your local convenience store will be covered. Your local McDonald's will be covered. It is every place that sells virtually any kind of food. It is it's the largest undertaking of its kind in history. It can't happen in 2 years. So we haven't built it into our numbers because we're not exactly sure when and how much and how rapidly it will go. Although I will say this, it's interesting. We're having more interest at this point than we anticipated a year ago. So the interest level is growing. Most people are not yet aware of it. They will be. But I'm guessing that this rolls in over the next several years, but we have not built it into our numbers at all.
Who are your competitors?
Wow. We have hundreds of competitors. In each of the spaces in which we work, there are typically dozens of competitors of various sorts. No one, interestingly, has the platform size, the scope that we have. Nobody does the sourcing, the vetting, and the actual activity that we do in forecasting. No one does that. So to a certain extent, we have what we call point solutions that are competitors, but we rarely run into competitors. The most frequent competitor we find is what we call roll your own, meaning a retailer doing his own work, not wanting a third party involved. Can't imagine why they do that, but it's true. So for the most part, we're not competitive. We have, because of the industry endorsements we have, nobody else has those. Our pace is not competitively driven. It's intentional to keep pace with relatively slow-moving customers because of the space that we're in. Supermarkets are slow. That's good.
What are the key factors for winning or losing customers?
Oh, God, I love that question. Well, there's 2 sales, right? The first sale is the initial sale. For the most part, I think the key factor is we're very well thought of. We're highly referenceable, which is important in this industry, meaning they will have heard of us. They may already use us for something where they're not paying for it. They're just getting the use of the system as possible. So in most cases, an initial revenue producing activity with a customer is really based on, we heard about you, this is a problem we have, can you solve it? That's the first win. Keeping the customer, boy, am I crazy about this. Keeping the customer depends on 2 things. Does our technology do what we say? In other words, if you're making a brand promise to someone, you're actually achieving that. And a huge percentage of the time we do. Not always, huge percentage. And then the second piece of it is, do they have any relationship with us? More of our losses, which are not very many, occur as a result of change of people, meaning the customer is acquired, the customer has new management, somebody comes in and they have a friend, a brother-in-law who does some piece of it. So it's rarely because we don't actually accomplish the mission. It's much more about, hey, new management team, you're not secure is really what typically happens.
What is the business model for new compliance rules and size of the opportunity?
Yeah.
I imagine it's huge.
Yeah. Well, The FDA, it depends on whether you believe government, right? That's like a religious question. The FDA has said the first group of products run across 16 different categories, things like nut butters, think Jif and all the different products that was in Jif peanut butter, tomatoes, etc., soft cheeses. There's 16 categories, but that covers, we're guessing, 8 to 10,000 SKUs that are in those 16 categories. 40% of the products that were recalled this year aren't even in those categories. So that means next year you can be sure the FDA will expand from 16 to 20 or 22 every year, looking at where were the problems and then, if you will, fixing what was last year's problem this year. So it'll start out with 16 categories, and eventually they've said, we want everything covered by this. So it's a big opportunity. We charge suppliers. That's why I would not want to be one of our competitors. Most people doing traceability, again, focus on the idea of a label. Dopey idea, will never work. But their theory is, well, we'll get a transaction fee. We'll charge a penny a box. No, that's not the way this industry works. That's not going to happen. So we have a flat fee. We're saying to a supplier, because we are a network, we're going to charge you about $200 a month or less for an unlimited use of our network to communicate with your customers. So we're going to flat fee this and make it very difficult competitively. On the other hand, it's certainly many tens of millions of dollars of possible revenue for us.
Can you increase the billing rates each year without losing customers since you're well entrenched and there aren't many other options?
Oh, yeah. I think we haven't raised prices in many years. This year we did some price increases. For the most part, because we're an industry insider, we're an industry player, we recognize it's a low margin business that we're selling to. And we need to lean in with them and make their lives easier, not harder. So if I were to say we would never lose a customer because we raise prices, that wouldn't be true. I don't think we'd lose very many because we're well entrenched and we're well thought of. And we like to price so that what we do is cheap. We literally are cheap. And that's deliberate. That's not an accident. It's how the industry sees us, that we're fair to them, and that we won't abuse the power relationship that we're in. So if we raised our prices significantly, I'm sure we'd lose a few customers. We just don't do that. It's just not in our nature to do that.
So other than share buybacks, what other opportunities do you have to put cash to use?
Well, there's 3 that I can think of. Buy back your shares, do a dividend, or do an acquisition. And there's actually a 4th called build your balance sheet. We're going to do all 4 of those going forwards. It would be my guess that in any given time period, depending on our cash generation, which is definitely accelerating, we'll do some of each of those potentially.
Maybe a follow-on to that question, Randy. You mentioned in the presentation you're running about $1 million a month of expenses and everything. Anything over top of that basically becomes cash flow. As the business grows, taking advantage of this traceability thing that will hopefully occur over the next few months and then over the next few years, as the business expands from, the $19 million, $20 million business to 30, 40 million, how much additional OpEx do you think is necessary to make it be a $30 million business, a $40 million business?
Oh, our internal plan says that our 12 million will go up, frankly, regardless of the top line customers, by a few $100,000 a year. It's our CapEx is de minimis. So our expenses are really, you can't say flat because they're going to go up a little bit, but we don't need to add more people because of the investments we've made in technology. Our headcount has been flat to declining for the last several years. Most of the incremental revenue that we would see from traceability will come from existing customers. So we don't even have to increase the size of the group that communicates with the customer. that same person can talk to them about multiple products. So the operational leverage from here is, we're pleased with the opportunity.
Maybe a last question, because we're bumping up on time. How proprietary is your traceability solution? Is there other options for these suppliers or retailers to comply outside of you at the price point that you're providing it at?
Oh God, no, not even, no, absolutely not. The flat fee is killer, because everybody else that went out and raised venture capital to do traceability did it on the basis of some variable cost. We're going to crush that. That won't work. But secondly, everybody else focused on this cuckoo idea of, we'll just put a label on the box. And you even hear some nutcases talking about, we're going to use the blockchain. And you kind of go, the blockchain? That's like killing a fly on your wall with a howitzer. Why would you do that? Why would you do that? So in the history of dumb ideas, that's pretty much near the top. The blockchain doesn't work because there isn't a blockchain. It's a label. Be clear. People say blockchain, think label. And that means somebody has to walk up to every single box. So envision, this is my favorite. I should show you a picture. Imagine you're at a distribution center. You're the guy running it. You've got 30 doors. You're 4 trucks deep at 30 doors to get them unloaded and get those products stacked inside your warehouse. And here's the question. Which of these damn trucks has a product on it that I have to scan? Which of those trucks? Wait a minute, it isn't even the truck. Which of the pallets in which of the trucks do I have to scan? The idea is so preposterous as to be, it's like you may as well put an RFID tag on every piece of asparagus. The idea is so fundamentally nuts. It can't happen, won't happen, has no economics. And here we are. And that's what people are thinking of as an alternative to the way that we're going to do it that doesn't require scanning or changing systems or anything else. I'm sorry, can you tell I get excited about that?
No, I can tell. Maybe one last question I had. I remember in a conversation I had with you, you mentioned, how efficiency driven you are at the corporate level. It's one of the reasons you can't imagine somebody competing against you, because most of the competitors are unprofitable or they're forced to, hit a number for next quarter or whatever it is. I remember you mentioning that you even had Salesforce throughout the organization, and you ended up pulling it because they couldn't customize it to the liking that you had, and you built your own CRM solution internally that you now use.
Yeah, that's an interesting point. I wasn't kidding when I said we only support one platform. One. That means our own CRM system runs inside of our platform. So it knows everything about our business. Every customer is in one platform. Every file from any of the applications, whether we're doing out-of-stock work or whatever we're doing, all of it is in one database, one application, and it gives us efficiencies that are cuckoo. Here's the best example of those. Randy doesn't like, I call it administrivia. Most businesses take really smart people and makes them into some form or another of administrators. Dopey, truly dopey. So our job is people should only be with people. Everything else can be automated. So we used to have a relationship in accounting. We had 800 customers. We had 5 people in accounting. Good thing my CFO's not on the phone, right? We had 5 people in accounting, 800 customers. Today we have 30,000 and we have 5 people in accounting. And when we get to 100,000, we'll have 5 people in accounting. That's productivity. That's productivity. Plus Randy hates accountants.